welcome back to The Explainer. Today we're pulling the curtain back on something that, well, let's be honest, isn't exactly the flashiest topic out there. But listen, the hidden mechanics of modern insurance, it's a massive, complex system that will literally drain your wealth if you don't know the rules. We're going to dive into the source material and build out a universal blueprint for personal insurance. We'll decode the fine print together and figure out how to protect your future without letting the system take advantage of you.
All right, so let's just dive right into it. Think about this wild modern ritual we all participate in every single month. You're not buying a car or a great dinner or a shiny new TV. Nope, you are handing over a huge chunk of your hard-earned cash for a piece of paper that you desperately hope stays tucked away in a drawer forever. Basically, you're betting on your own misfortune. And in this particular casino, as you probably know, the house almost always wins. So we've got to ask, are you getting cooked by the shadowy algorithm? Because if you don't understand the rules of this invisible force deciding your financial fate, you are absolutely going to get caught in the traps buried deep in the fine print. But good news, the source material actually gives us a clear blueprint to sidestep those exact traps. And that's exactly what we're unpacking right now.
Here's the game plan for today. 1. Health insurance and biological risks. 2. Auto insurance and the trust algorithm. 3. Life insurance, valuing your time. 4. Home insurance and rare events. And finally, number 5, how to actually rig the game. Okay, section 1. Health insurance, biological risks. First up, let's tackle the biological risk that completely bypasses you and hits your paycheck before you even see it. The sources frame this in such an interesting way, calling health insurance a social construct. Whether we're talking private insurance or a tax like Medicare, it's all built on this shared reality that we're physically vulnerable. Any of us could just break down. It's basically the required maintenance cost to keep your human mechanics running, acting as a financial firewall so a single hospital stay doesn't turn your whole life into a financial fire. And the sources lay out this brutal 3-step cycle we all go through. Step 1 is the monthly premium. It's this slow, quiet erosion of your bank account, whether you're running marathons or stuck in bed. Then step 2 is the peak. When you actually get hurt, it feels like wrapping yourself in the world's softest blanket, right? You think, oh, thank goodness I'm covered. But then, bam, step 3, the come down. This is the infamous deductible trap, where you suddenly have to shell out a massive flat fee right from your own pocket before the insurance company even thinks about stepping onto the playing field with you.
Moving right along to table number 2, auto insurance, the trust algorithm.
Auto insurance is fascinating because, according to the material, it's actually less about protecting the physical metal machine you drive and way more about navigating this shadowy algorithm of trust on the road. The real value here isn't the Kelley Blue Book price of your car. It's your liability. Lenders and the government basically demand proof that if you accidentally pilot your 2-ton vehicle into someone else's property, you can take legal responsibility and actually pay them back for the chaos you caused. And because of that, if you've got a history of accidents or a so-called trash score, the price of buying that trust just skyrockets. It honestly starts to feel like you're paying rent just to exist on the road. The massive takeaway here is that you are essentially the money supply for a middleman. And that middleman, they're just placing a statistical bet on your daily routine. They're betting that you are patient, predictable, and, well, boring enough on your commute to never actually crash. You are literally paying them to trust your boredom.
Okay, table 3, life insurance, valuing your time. This one is the ultimate time bomb for wealth building because we're looking at the one thing you can absolutely never get more of. The big idea here is that with life insurance, you are assigning a highly specific, measurable value to your own existence. It's kind of wild to think about. Just like society collectively agreed that a little green piece of paper is worth more than a stick, you're doing the exact same thing with your life and your time, which is without a doubt your most precious asset.
The harsh reality check is that this policy is mathematically designed to replace the thousands or maybe millions of dollars of value you would have generated for your family if your personal countdown ended early. You aren't just insuring your life, you're insuring your future time and your future potential.
But listen, you've got to be super careful which version of this game you play. Term life acts a bit like simple interest. It's a flat, straightforward fee for a set window of time. If you survive the term, great, but that money you paid vanishes like monopoly money. Now, whole life, on the other hand, is heavily pitched as an investment, but the source material warns it can be a massive trap. Because of these complex fee structures and super slow cash value growth early on, it sets up a dynamic where the clones of your money are actually working way harder for the insurance company than for you. You pay them huge premiums, and they turn right around and invest your capital to score massive returns for themselves.
All right, down to our fourth table, home insurance, protecting your fortress.
So this is all about protecting the sticks and rocks you call home. Whether you own or rent, this type of insurance is your main safeguard against absolute worst-case scenarios, things like fires or theft. We're talking about incredibly rare events. These are those lightning strike moments you pray never, ever happen. But, you absolutely have to prepare for them anyway. Now, if you're a renter, you really need to hear this, because relying on your landlord's policy is pure Hollywood fantasy. I mean it. Their insurance covers the building itself. It does absolutely nothing for your personal belongings. It's not covering the burritos in your fridge, and it's sure as heck not covering the jet skis in your garage. If you don't have your own renter's policy, you're walking a giant red flag. You're risking literally everything you own just to save, a few bucks a month? It's simply not worth it.
Which brings us to Section 5, the fix, how to rig the game. Now that we've exposed the traps across all four of these tables, it's time to talk about the fix. Because the secret here isn't trying to completely dodge the casino. You can't. That's impossible. The real secret is mastering their rules. You have to stop chasing the trail of the absolute cheapest monthly premiums because, honestly, those usually just drag you into higher deductibles and hidden traps. Instead, zoom out. Look at the total value of the protection you're buying. Once you truly grasp the human mechanics of risk, you stop getting fooled by cheap price tags and you start locking down genuine, bulletproof security. So, I'll leave you with this one final thought to chew on. At the end of the day, is insurance going to be your worst enemy, slowly draining away your wealth month by month, or is it going to be your best unpaid employee, tirelessly protecting your future in the background? That choice is entirely up to you. If you want more explainers that decode the fine print of these wild, hidden systems, drop a comment below and let us know what source material we should dive into next. Make sure you hit subscribe to keep your brain electric and keep your future protected. I'll catch you in the next one.